Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
Today, we're unpacking a crucial review of the Q3 U.S. equity market structure and asset allocation. Let's dive right into this.
This video presents a direct informational narration of the source document. So, if you've been watching the markets lately, you've probably felt like things are, contradicting themselves, right? Today, we're going to break down exactly why that's happening, using direct insights from recent market data.
Here's our roadmap for today. We'll cover the stock market divergence, the AI capital rotation, earnings versus positioning, and the actual mechanics of market deleveraging. Then, we'll wrap the whole thing up with a strategic action framework and some forward market scenarios.
All right, Section 1, the stock market divergence. Right now, we're seeing a massive contradiction in the market. The big overarching indices, they suggest total calm and stability, but underneath the hood, individual holdings are facing some serious structural drawdowns.
You see, while the S&P 500 and the Dow are hovering near historic highs, that surface stability is kind of just an illusion. The QQQ, the Russell 2000, and the SMH Semiconductor Index, they are absolutely bleeding momentum. In fact, the SMH retreated 16.7% in just half a month. This isn't your standard broad risk-off event. No, it's a complete separation between index direction and what's actually happening in individual portfolios. Moving to Section 2, the AI capital rotation. Here's the thing. Capital isn't actually exiting the equity market right now. Instead, it's aggressively rotating.
Just look at the path of this capital. The Magnificent Seven gained about 6% in July, getting a nice boost from weaker CPI and PPI data. But concurrently, capital literally fled crowded AI hardware and high-beta growth stocks, flowing straight into mega-cap tech, financials, and healthcare. And because market liquidity is constrained right now, every new inflow basically requires a forced sale somewhere else. It's a zero-sum game.
Section 3, earnings versus market positioning. So, this begs the question, why are exceptional corporate earnings suddenly failing to support stock prices?
Consider TSMC's data. We're talking 36% revenue growth, a 77% profit surge, and a $64 billion CapEx ceiling. Flawless metrics, right? ASML also beat their earnings expectations. Yet both of these stocks faced immediate selling pressure. Crazy, right? Well, why did that happen? Because these incredibly strong earnings simply provided the liquidity windows that institutions needed to take their profits. Right now, short-term price paths are being dictated by crowded positioning, absolutely not by the fundamentals. All right, Section 4, mechanics of market deleveraging. How exactly does localized profit-taking accelerate into a massive mechanical sell-off? The numbers on this institutional sell-off are frankly staggering. The Morgan Stanley Tech Momentum Index dropped 35% in just 17 days. Meanwhile, the Goldman Sachs High Beta Index fell 24% in half a month. The initial drop might be standard profit-taking, sure, but what follows is purely driven by mechanical, forced selling.
This happens in a very specific four-step deleveraging sequence. First up, CTA trend breakdowns trigger systemic selling. Second, dealer negative gamma hedging accelerates that selling. Third, a contraction in market liquidity amplifies the downward price impact of every single order. And finally, step 4, over 700 leveraged ETFs are forced into late-day rebalancing. This creates a vicious, self-reinforcing downward spiral. It's like a snowball rolling down a hill.
And this creates incredibly dangerous cross-market feedback loops. Take SK Hynix, for example. Extreme volatility in its US ADRs directly impacted local Korean shares. This contagion contributed to the KSP dropping 7.6%, literally triggering its 8th circuit breaker of the year. This was alongside major plunges in both Samsung and SK Hynix. Risk just transferred back and forth across markets, made so much worse by arbitrage.
To put that into perspective, after a 27% single-day surge, the forward PE of the SK Hynix ADR rose to 6.2 times. That entirely erased its previous discount. And with a recent opening for two-way conversion between the ADR and local shares, this high premium is at serious risk of even further compression. The carnage in the hardware sector is severe. AAOI nearly halved from its May high, COHR retraced roughly 40%, and MRVL fell about 45%. Plus, MU faced a major technical breakdown. But here is the absolutely crucial takeaway for you. A massive drop doesn't mean it's immediately time to buy. The mechanical selling simply has to exhaust itself first.
We're actually witnessing a fascinating dual redistribution here. On the enterprise side, IT budgets are heavily shifting towards servers and memory. This is actually delaying software contracts at firms like IBM. But financial capital, it's doing the exact opposite. It's fleeing public AI hardware and flocking straight to megacap platforms and private AI valuations, like Anthropic's reported $1.2 trillion secondary market quote. Yeah, $1.2 trillion.
Section 5. Strategic Action Framework. So how do we categorize these assets based on odds, win rates, and price paths moving forward? Let's look at the landscape. Megacap tech offers high win rates, but thanks to recent inflows, your odds are definitely narrowing. AI hardware? It has improving odds because of the sell-off, but win rates remain low until the falling stops. Financials and healthcare offer some great low-beta defense right now. And event-driven stocks? Well, those require strictly isolated risk management. Speaking of which, event-driven volatility is creating massive ripples out there. UNH surged 9% at the open on earnings. PayPal caught momentum from a rumored $60.50 buyout by Stripe and Advent. Lucid faced intense binary volatility from bankruptcy rumors and a subsequent denial. And SpaceX broke below its $135 IPO price alongside a massive put-to-call ratio.
Finally, Section 6. Forward market scenarios. Let's look at the potential market trajectories and what indicators you really need to watch next. For an upward path, we absolutely need the QQQ and SMH to stabilize and synchronize with the broader market. But if we head downward, the huge risk is that AI hardware selling pressure expands directly into megacap tech. This is especially true if the VIX spikes from its current lows and completely breaks the market's fragile balance.
In a constrained liquidity environment like this, stock trajectories are dictated by the valuation the market is willing to assign at any given moment, not just the underlying fundamentals. The true advantage isn't in trying to perfectly predict the exact bottom. It's having the patience to confirm when the mechanical selling has actually ended. The source document's final observation is perfectly clear on this point. So looking at your own portfolio today, are you catching falling knives, or are you waiting for the dust to settle?